Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, there may be a chill in the air, but today we're getting away from it all by looking at some of the big share price winners of recent years. The airlines, the likes of Jet2 and sporadically EasyJet, have benefited significantly from the post-pandemic revenge travel boom. But are cost of living pressures now making customers think twice? Mike Fahy is here to discuss what companies have been saying this week. There's also a chill in the North Sea at the moment, and perhaps ever more given the pressures of the energy transition on oil and gas companies. Our cover story this week asks what's next for those businesses. Alex Hamer joins us to talk about that and the companies that are still throwing off cash in the face of higher taxes and structural trends. We'll wrap up with a look at the big topic of shareholder democracy. Should private investors do more to vote their shares? Do platforms actually let them do so? Are investors that fussed? Holly McKechnie will share her thoughts. We're going to begin, though, with the airlines, and not just because I'm going on holiday this weekend. Mike, we've had a couple of reports in recent days, Jet2 and EasyJet, as I say. Let's start with Jet2 because they've been a company that has done really well in recent years. EasyJet's done pretty well too, but let's start with Jet2 and their figures. What do they look like this time? Are they still keeping up the momentum?
Yeah, they are. Top line growth was quite strong still, 15%. Operating profit similar. And pre-tax profit ran slightly ahead of that. It was up by about a fifth. I mean, these two are, I suppose, the two most similar if you're comparing airlines, in that they have the low-cost flight business, which is where they came from, but increasingly both have done very well out of package holiday business. EasyJet started its package holiday business kind of pre-COVID, but it didn't really take off until afterwards. And I think last year was the first year they made serious gains out of it.
Yeah, we'll come to the package holidays in a moment, because, as you said, that is a big driver of success here. EasyJet was also fairly positive this week, wasn't it? Again, still seeing solid demand, which is interesting in itself because over the summer, the sector, clearly not everyone in the sector is a low-cost carrier, but we did see not profit warnings, but warnings on the strength of demand from all manner of airlines, really, including Ryanair.
Yeah.
But that doesn't seem to have translated for EasyJet and Jet2 so far.
No, there are obviously slight differences with the model as well. I think when you look at the likes of both Ryanair and Wizz, they are still kind of more purely the cheapest of the flights, the lowest cost fares, to get people to whichever destination on and charge a bunch of ancillaries. EasyJet has become much better at charging for ancillaries, and that was really reflected in this week's results. Ryanair is still the biggest in this market, and it was facing, at the start of the summer, a lot tougher conditions. You know, Michael O'Leary had been talking about this idea of revenge spending easing slightly and the cost of living pressures getting to people, and it certainly wasn't enjoying the growth in ticket yields as it had been in the last couple of years. They were flat or up low single digits, whereas Jet2 and EasyJet have both managed to pass on additional costs and have got passenger revenues running slightly higher than passenger growth. Yields, they're not immune, even at these two. I think with Jet2, it posted a slightly lower ticket yield of only 1% or something, the drop in the ticket yield. But that was more than compensated for by the big pickup in the number of passengers it carried.
Yeah, as you said, there has been a slight drop-off, but these two in particular have shown they can pass on cost increases. So far, there may be some weakening coming down the line. Let's talk about the package holiday side of things, though, then, because airlines typically not that profitable. Package holidays are a bit more profitable. It makes sense, therefore, for them to move into them, and they have had success. EasyJet, though, in particular, seem to be putting, when they're talking about the year ahead, putting a lot of faith in further expansion there.
Yeah.
Do we think they can both expand at the same time?
Yeah, I do. I think it's kind of understandable that EasyJet is placing more of its emphasis on growth in that area because it's coming from a lower base. Jet2 is really the one that's driven this model. You know, it was doing big package holiday deals 10 years ago, and the current chief exec, Steve Heapy, who took over from Philip Meeson, who grew Jet2 from this kind of scrappy little cargo airline. When Meeson decided he was going to step down, it was kind of obvious that Steve Heapy would take over because he's the one who's delivered this incredibly profitable package holiday business. The margins on the holiday side are higher than they are for flight only, as you'd imagine, but they get good customer service reviews from it in general. I know someone who flew with them last year during the Greek wildfires, and they weren't as pleased with them when they were stranded. But in general, you know, these are businesses both that are heavily weighted towards the summer anyway. But the package holiday business has proved quite resilient. I think it's about 70% of all of the people who are on a Jet2 flight are one of their own package holiday customers. And the increased cost, they all talk about increased cost, but again, that's more than compensated for by them being able to push up ticket revenues.
Yeah, that seems like a fair assessment. What about valuations then? Because there have been, certainly for Jet2, it's had a big run up over a long period of time. How do you see the relative valuations of the two companies at the moment?
Yeah, it has. When you look at them from just a kind of standard PE ratio, neither of them look that expensive still. Jet2's on 8.5 times, EasyJet's on 7.5 times, but both are still, when you look at the earnings forecast, there's still quite strong earnings forecast growth planned for them both. I mean, the PEG ratio that we look at occasionally, which is the amount you're paying for the earnings growth for EasyJet, it's down at zero point 0.5, and generally anything below 1 is considered good, anything above 1 is considered expensive. There is some kind of strong upgrades coming through for EasyJet, and that is linked, as you mentioned earlier, to holidays, which we said is a new offer for them, but it made up about a third of the overall trading profit for the period just gone.
And certainly in the case of Jet2, some of the supply issues that have dogged the sector are less significant as well. It's been taking on more Airbus planes too, so it has the capacity, it has been able to scale up, which a lot of others have struggled with, has been a problem.
The issues that have hit the others with Ryanair, it's very much a Boeing issue. Ryanair is pretty much, apart from a couple of legacy planes, it's a Boeing only airline, and Boeing's failure to be able to meet anything like delivery schedules has sort of hampered Ryanair's growth plans. Wizz, similarly, it's a slightly different problem with Wizz. It's the Pratt and Whitney engines that are in many of Wizz's planes. Pratt and Whitney's been grounding flights, and Wizz all of these low cost airlines have very ambitious expansion plans, and I think we could come to that. But with Wizz, it's their expansion. I put them on a sell tip about a year and a half ago. My issue with it was the kind of scale of their expansion plans would mean that they are going to run up against Ryanair in a lot of routes, and B, the kind of starting level of the debt that they're on makes the expansion on their part a little riskier. You would think that it is going to affect future ticket yields, but with these groundings, they haven't been able to expand as quickly, and as a result, you know, the lower capacity has meant reasonable levels of being able to charge people.
Maybe we should wrap up with touching on IAG, which is slightly different kettle of fish, albeit EasyJet does compete with it a bit more nowadays. It's This is a company whose share price is up almost two-thirds this year, which is quite remarkable, really, when you think about some of the reputational issues they have at British Airways. But that's really a testament to the fact that they are still making a lot of money from transatlantic routes in particular.
Yeah, got to admit, I haven't looked at IAG's most recent results, but over the summer they were doing very well. And as you said, it was pretty much the transatlantic route. It's a very different business model, and with the wider group, IAG has also had quite a bit of success with Iberia and linking flights into South America. There's been good traffic growth there as well.
Yeah.
I think the one thing that IAG has that maybe when you look at its direct comparators, like say a Lufthansa or a an Air France KLM, one of the benefits is that it's not being as exposed as some of those, or even the privately owned Middle Eastern ones like Emirates, to flights to China, and that is a part of the market that still is slow to recover.
Yeah. Well, I'm flying with BA this weekend. They've already changed the airport, cancelled one flight, so hopefully won't be anything too serious from my own perspective. But it does make you wonder sometimes how much longer those reputational issues can coexist with IAG's success. But equally, as you say, it's important to remember that Iberia, etc., there are several different airlines in the mix for them, which is part of the reason they're doing so well.
Yeah, I mean, your experience of them cancelling flights is sadly, I do think from the British Airways perspective, it is improving, but it's still from a level where it's been under-resourced from the pandemic and has picked up. So there were customer service problems last year. This, but most recently, obviously, there was the IT issues. But I don't know. It's it's always easy to look from into the future and think, well, these are one-off problems. But if you continue to get a series of one-off problems, then reputation does take a little bit of a hit, doesn't it?
We've spoken before on the show, haven't we, about some of the difficulties they had post-pandemic when they'd got rid of a lot of staff and they couldn't scale back up, which is one reason Jet2 did so well, isn't it? I remember you writing earlier this year that they made the decision to retain thousands of staff so they could bounce back very quickly. But there we go.
So one other note on, sorry,
Yeah.
because you mentioned capacity, I think the one word of warning with the low cost airlines is that within a couple of years, the issue for a lot of companies now is being able to get hold of planes, and the Airbus planes in particular are the ones in hot demand now. Both Jet2 and EasyJet do have kind of large, substantial orders that are, in Jet2's case, bigger than the size of its current fleet, and in EasyJet's case, it's around the size of its current fleet. So they're doubling over the next 10 years or so. And there's a very scary looking CapEx chart in Jet2's results when you look at the future CapEx commitments. You know, they're currently spending about 400 million a year, and if you look in 2-3 years' time, that ramps up to 700 million and £1 billion a year. So it has plenty of cash on hand at the minute, and its bet is that it will be able to continue to fill these planes to be able to service all of this extra capex. But it is something that investors should look out for.
Indeed. Let's turn from one set of polluters to another, because we're going to look at the North Sea now. Our cover story this week, Alex Hamer. Clearly, this is a topic that's been in the news all year, partly because of the change of government, partly, therefore, because of uncertainty over how the energy profits levy would evolve. We do have some clarity on that now after the budget, which, in theory, provides certainty in that regard, but there are a number of other uncertainties for the oil and gas sector in the North Sea, as you would expect in the year 2024. Why don't we start by talking through some of those other issues the sector is facing? We know what the EPL has set out now, the investment allowance has been resolved, but there are other questions that are unanswered.
There are, and we're looking out to 2030 now, which is getting scarily close now that we're almost into 2025. And for the budget, there was a really big push from the oil and gas industry to try and maintain their tax offsets, which means that when they invest in new projects, they get a bit of a discount on their taxes on their energy profits levy. And now, once Rachel Reeves stood up and basically said very little about what they were going to do, apart from saying most of the allowances would be maintained, and confirm that the 38% levy, which comes on top of 40% corporate tax, the focus quickly moved to what happens once that levy expires at the end of 2029. And it's an interesting moment for the industry because for years there's been talk of diminishing production, and production's about halved in the past decade and is set to go from, by 2029 it'll have halved again from where it was in 2020. The big discoveries are just not there anymore. And so companies are focused on these shorter cycle investments that might be infield drilling, so they're adding wells to existing fields as opposed to developing new fields. And that's the path the North Sea's been on for a long time. And it's also obvious in the companies that operate there. So the mid caps that we write about a lot. So Serica, Enquest, even one that's kind of come back that I hadn't covered for a while is Capricorn, or former Can Energy. And their business model is just to buy old fields or sets of wells and just make sure they're running as well as they can. And they make a fair bit of cash out of that, especially when energy prices surge. But there are still a few big projects, and that's I make that distinction just because there are a few really big projects that are still to be developed in the North Sea, and that's where the focus is at the moment. The reality of most North Sea production is they're very mature fields where companies are just, just scraping out what they can over the next decade or so. But the uncertainty comes after 2030 on whether there will remain a windfall tax. The industry argues that there aren't any windfalls, so relative to historic profit levels. So the whole thing should be scrapped. There is a mechanism in place where if oil and gas trades under a certain price level for quite a while, then it is scrapped. But they actually set that cap quite low. But now there's the future of the levy. There's also a court case in Scotland where they'll decide whether some of those big new fields that I was talking about, so Jackdaw, which Shell owns, and Rosebank, which is Equinor and Ithaca Energy, whether they'll have to go back for permission or approval of their environmental permits by the government now that the criteria have changed.
There's been a court ruling since they were given those permits. Now the question is whether effectively the findings of that ruling should apply to these permits that were already granted.
And it puts Ed Miliband, the Energy Secretary, in an interesting position because Labor has promised to block new permits for North Sea oil and gas projects, but they didn't challenge this case. They didn't join the oil and gas companies in doing that, but they did acknowledge that the Finch ruling, which was mid-year in the Supreme Court, does set a new precedent. So the reporting from Scotland. Unfortunately, our massive travel budget didn't extend to me going and sitting in court for 4 days while everyone else put the magazine together. But what the sense was from reporters there was that the government just wanted to remain a bit neutral and hope that the decision didn't come back to Miliband's office because it puts them in an interesting position.
Yeah, it does seem they are slightly uncertain on some of their policies on that front, or trying to have it both ways. Let's talk about a bit more about the nature of the sector. I think you've touched on it already, but the opportunities, such as they are for these companies, it is their business. They see effectively filling the void left by some of the bigger players. You're still seeing bigger companies pull out of the North Sea at this stage, and they think they can capitalize on that.
And the latest two examples I'd give would be Harbour Energy, which is one of the biggest producers. The company has just completed a huge merger with Wintershall DA, which means that the majority of their North Sea production is now in Norway. And this is something that the company had thought about for quite a while, and they've been one of the more vocal, or the management has been one of the more vocal management teams about North Sea tax rates and operating conditions, and they've already cut workers and investment, blah, blah, blah. But Linda Cook said, the CEO said that they couldn't really afford Norway before, and then they've managed to pull that deal together because of basically the divestment plan that's landed them with this huge portfolio. And there's been reporting in recent weeks that they're also wanting to sell off some of their British assets. Now, Harbour is interesting because the production is still quite high in the North Sea, but there's also discoveries being made that I mentioned in the piece. There is still some exploration spending. There's development and improvement spending that will keep production going. So they're in a bit more of a constructive position than say Apache, which is an American company which has also been quite vocal. But the most recent announcement is that they'll take an impairment on the UK assets and effectively stop production by 2029. And to me, that shouts, as you alluded to in your question, that shouts just please buy this from us. Then we can fully get these assets off the books. So I think the way management put it was that they'd be leaving 17 million barrels of oil under the sea as the current plan stands, which I think is quite unlikely. And now the combination of those withdrawals with lack of investment in major fields, talked a bit about Rosebank. We've also got Cambo, which is 100% owned by Ithaca Energy. It's about 20 miles south of Rosebank off the Shetland Islands. And that project is much more up in the air. I think, one analyst puts it as a 25% chance of getting to production. It could be even less given Labor's unwillingness to issue new permits, the investment landscape, aka how much money you can get from lenders. The combination of those quite uncertain development projects, the existing availability of mature wells and fields with these companies like Serica and Enquest and Capricorn, like I mentioned before, with huge tax losses sitting on the balance sheets. And that tax loss is something that will offset the corporate tax, which sits at 40% for these oil and gas companies. That is an actual asset because they can use those losses to actually make those projects a lot more economic. Talking to Serica a few times this year, the view is that the company would like to expand internationally, but also recognizing that there are massive opportunities in the North Sea still because of their specific situation. There's a lot of negativity or potentially a lot of, depending on your point of view, it's realistic to say that the North Sea is diminishing rapidly as a source of oil and gas, and many are pushing for that. But also, there are these London-listed mid-cap companies that are going to be generating a lot of cash flow from it in the next 5 to 10 years. Beyond that, it's a lot more unclear. But the interesting thing reporting this is that people are agreeing, or the reality of the situation is that campaign groups like Greenpeace and Uplift are calling for things that are basically already happening because of the investment landscape. You don't need to bring in a lot more regulation to slow down North Sea production. I mean, it's already coming down.
I mean, there are transition demands on those who are still working there as well, as you would expect. How well equipped are they to adapt to those electrification, things like that?
This is probably the other. Well, I wouldn't even say uncertainty. The rules are there; they have been loosened, but to sketch them out briefly, the requirement that's been set out by the North Sea Transition Authority, if you've got a new rig coming in towards the end of the decade, it will be electrified, and that's because of a focus on operational emissions, which are minuscule compared to the emissions that are generated when you burn the oil and gas that's coming through. But you got to do what you can if you're going to keep producing this stuff. And the carbon intensity through an electrified rig, and they're already up and running in Norway, is much lower. And the flip side of that is that, say, Ithaca, they have a field that's called Captain. It's been in production since the late 90s. The previous CEO told me earlier this year that it would cost them about $350 million to electrify Captain. And that's retrofitting an existing rig, so it's going to be a bit more expensive, but that's what you're asking for. And these are massive infrastructure projects. The energy demands are super high. If we look at Rosebank, for example, this big new field that Equinor is developing, they would have to put in wiring over 130 kilometers out from the mainland to electrify that platform. And this is a platform that they've talked about getting into production by 2027, 2028, if there aren't any permitting issues to come from this court case. But that's pretty close to when this deadline hits. And they haven't they've internally costed, but they haven't included the funding of that electrification in the total project costs. That might be an extra few $100 million to get that completed. So kind of all these things stacking on top of each other, they mean that companies are less likely to invest overall. Which the irony is, if you bring in these requirements for much cleaner running platforms and they knock out the platform entirely, that could be a win for someone who's focused solely on North Sea operational emissions. But then the industry argues that, hang on, then we don't have that production coming in, then we just have to import that gas, for example. I mean, we import a lot of oil already, but it's those imports that you have the operational emissions from wherever they come from, and then the emissions from transporting them. So the industry argues, if the demand is there, then we should be producing it locally. And this piece focuses a bit more on the actual operating conditions at the moment and how this looks on a balance sheet. But that's effectively the battle, I think, that is going to continue for the rest of this parliament, at least. that the demand remains. So is that going to be fed from the North Sea or else?
Yeah, there are a lot of these trade-offs you consider, aren't there, in all parts of the energy story, including the energy mix, as you mentioned in the piece. Gas, given the scale of the heat pump rollout or the lack of scale there, gas is still going to be in demand for heating for some time. And then you look at things which you also talk about, the Drax's power plant, which provides the biomass power plant, which provides electricity for 5 million homes. But at the same time, according to some research, which I think Drax can test, but suggests it's the single largest carbon polluter in the UK. It's not a clean source in and of itself, but it's deemed cleaner, isn't it? So some of these decisions need to be, not looked at again, but there's some working through of these trade-offs perhaps for the government and regulators to consider in future.
I'm not jealous of all this sitting on Ed Miliband's desk. I mean, the Drax decision is whether the government continues or extends the agreement to keep paying them hundreds of millions of pounds a year to run this massively polluting power plant. It's putting out more carbon than a coal plant would. And yet it is quite important. I'm sure Drax would argue it's crucial for the energy system, for the maintaining proper supply to the grid. The company is working on adding carbon capture to it, but cost, timeline, how well it will actually work, it's unclear. The interesting thing that I understand is BP is working on that pipeline that will connect the Drax power plant in Yorkshire to an existing chemicals plant or processing plant. So this infrastructure is being built up for the decisions being made to support Drax through its biomass plus carbon capture plant, which is the only reason that the plant would be able to continue well into the 2030s. Yeah, once again, a fairly tricky situation.
Well, these are all discussed in the cover feature this week, available in magazines online as usual. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. For now, though, we are going to wrap up with a segment on another big topic. Well, it certainly sounds like a big topic: shareholder democracy. One of the most important democracies there is, certainly from our point of view. But is it actually an issue from shareholders' point of view? We might get to in a minute, because certainly for companies, for people, I think there is some frustration, Holly, isn't there? You see with companies and shareholder votes, if you have a large private investor base, quite often it's difficult for them to reach a minimum floor of votes required for motions to pass, because not enough people do bother to vote or are able to vote. There have been some moves by platforms to make this easier in recent years, which is only fair because, as you write this week, the emergence of platforms has inadvertently led to difficulties with voting because you're not individually down on the shareholder list. AJ Bell has become the latest to make a move in this direction. What has it done?
Yeah, so AJ Bell has simplified the process for platform users who want to vote in annual general meetings. So now you can do it online via the platform itself, and customers will get an email alert of any of their holdings of an upcoming vote. Beforehand, customers who wanted to vote had to send AJ Bell a secure message with their voting instructions, and it's a bit of a sort of convoluted process that could be a bit off-putting for customers.
Yeah, you could see why people would find that too much of a hassle, or while they would not even be aware of votes coming up. So the notification service is quite significant. This follows on from Interactive Investor, doesn't it, which did something similar and saw quite a big uptick in engagement when it did that a couple of years ago.
Yeah, so Interactive Investor did a similar change back in 2021 when it sort of set it as the default position that customers could vote at AGMs. And before that, customers had to request the right to vote. So it did see sort of quite a positive uptick in voting after this. So the number of votes it processed rose by 30%, and AGM attendance actually doubled. So it was quite a positive step in the right direction.
It's probably fair to say that it's definitely fair to say measures are inconsistent across the sector, though. What do some of the other platforms do? It's not going to sound very positive when you describe the hoops you have to jump through here, I think.
Yeah, so there's a bit of a mixture. Hargreaves Lansdown, so the other sort of really big platform provider, users have to get directed to a third-party provider via the website and then give their voting instructions that way. At Charles Stanley Direct, you've got to send the platform, a secure message sort of outlining your voting instructions. And you've got to do it 6 days before the AGM, so you need to be sort of aware in advance when that is. And the same process applies if you want to actually go in person to the meeting. And then again, at Best Invest, you have to request either in writing So that could be an email, or it could be a secure message, or by the phone if you want to sort of attend or vote in any of the meetings. So yeah, a real sort of range in different ways of doing it, and sort of can be a bit off-putting.
And some research from, I can't remember when it was, this year, a couple of years ago, but there was some research from Interactive Investor on people's preferences and also the reasons why they didn't vote. It may not be surprising, given some of the rigmarole you've just described, that time was a big factor for a lot of people. There were various other things cited as well, though, in terms of why they didn't vote or why they couldn't vote.
Yeah, so that was this year that Interactive Investor did that research, and about half of the people who responded said they didn't participate in AGMs at all. And of that half that didn't participate, actually they said they didn't face any barriers in terms of how the platform's set up or in terms of how the company's giving them information. So that was really sort of disinterest in the process or in actual voting, which is sort of a worry, and that's not really something the platforms themselves can necessarily solve. And then, yeah, in terms of the biggest barrier that people cited, that was time, and said about a quarter of respondents said that they didn't have time to sort of access the information or read through what they saw as sort of complicated proposals and then make an informed decision to vote. So again, that's more tricky for platforms to sort of sort out themselves, and it was actually quite a low percentage that said that there was issues with the platforms that were preventing them from voting.
Although you could interpret time as being an issue with platforms, perhaps, in that they know the system and they just don't want to engage with it. It does feel there is an obligation for platforms to make this available, even if people don't make use of it, given these investors do hold shares in these companies, in these investment trusts in some cases, so they are entitled to vote. Certainly prompting them as well is a useful part of a platform. I do wonder whether there's a bit of a chicken and egg situation too, where this is highlighted more, but might make more use of it. Ultimately, though, there's the question, isn't there, of whether retail investors think their voice actually counts. They might think, oh, I'm interested in this issue, but my vote isn't going to count, versus all these big institutional shareholders. It's not like thinking your vote on election day won't count, where it's at least everyone has one vote. If you're up against a shareholder with 10% of the shares, it's going to be difficult for you to make your voice heard. What about, to wrap up, do we think other platforms now will follow suit? Because it's taken a little while for AJ to follow II. I mean, it'd be interesting to see, won't it, whether others follow suit. Hargreaves is the other big one, but so far they seem to still be focused on this third-party system.
Yeah, I think the sort of difficulty is that platforms aren't necessarily incentivized to make these changes. So the issue being, like you said, that is the nominated accounts that you put in if you use a retail platform, and that means that there's quite a big administrative burden for platforms to then alert you that there's a vote, and there's a cost to that. So it's whether or not, I think if there's not a demand from retail users to actually make their voices heard, then there's not necessarily going to be a reason for platforms to make those changes. So sort of has to come a little bit from the retail investors themselves.
Yeah, it is a bit of a thankless task in some ways, but we will thank them if they do it. So there's one they've got. That brings us to the end of today's show. We have run out of time, unfortunately, but thank you very much to Holly, to Mike, to Alex, to our producer, Maddie Apthorpe. We are away next week, but we will see you in 2 weeks for another Companies and Markets show.